Hey everyone, thanks for watching. I'm Chris Hill. Welcome to Fool Global Headquarters here in Alexandria, Virginia. I am joined by Andy Cross and Jason Moser. Thanks for being here, guys.
Thanks, Chris.
We're going to be taking your questions on stocks in just a second. Go ahead and type those in the comments section. We're going to get to them in a second. We got to start though with the story of the day. And as sports fans, we like when sports and business interact with one another. And the big story in the sports world and the business world, Nike. For those who missed it, last night, the classic matchup in college basketball, Duke against North Carolina. The star player for Duke, Zion Williamson, wearing his Nike sneakers, out 30 seconds into the game, blowing out his sneaker.
Yep.
Maybe we shouldn't be surprised that shares of Nike are down just a little bit. But fairly or unfairly, people asking the question like, wait a minute, how big a problem is this for Nike?
I don't think it's a big problem at all. I mean, I think this really, it's obviously horrible timing, bad news for Duke, for Zion. I don't think that this is something that affects Nike in the long run. I mean, obviously we invest focused on the business as opposed to sort of the day-to-day machinations of the market. I can understand the headlines wanting to jump on something because you have to have headlines for something. So it's obviously bad news for Duke, bad news for Zion. I don't think this affects Nike. Let's think about this from the perspective of back in September. Okay, look back in September. September 4th, the news was that this Colin Kaepernick deal was going to kill Nike. That everybody was just up in arms about this. Nike stock plunged based on this news. Okay, you go to December 21st, they released their earnings. Hey, it looks like it's not as big of a deal as we thought. So you could see leading into that earnings, there was a nice little trough that developed. Right after that earnings, Nike has just been on a straight shot up. And so I would look at this and say, if we develop that same kind of trough from this news cycle, investors have to look at this as a potential opportunity either to add or to open a position Nike. This is not the kind of stock that you want to sell based on a headline like this.
Yeah, I agree with that, Jason. When you just think, I mean, unfortunately for Zion and for Duke, who lost yesterday, sad, especially for those who are Duke fans out there. It's the big picture of Nike is much more than even just one player. I mean, like, while the shoe deals they structure, and they have an amazing one with Duke, and Zion has an insurance policy with Duke, so they will be fine. The big picture of Nike, though, this company and the way that they can innovate, and they spend so much on both marketing and R&D to develop leading shoe technology, of which they have a leading market share. I think long-term, the perspective for Nike shareholders remains positive. And seriously, if the stock takes dips on this news, I think it's a good buying opportunity.
Here's the official statement from Nike, okay? We're obviously concerned and want to wish Zion a speedy recovery. The quality and performance of our products is of utmost importance. While this is an isolated occurrence, we're working to identify the issue. Let me be clear, that photo of him that we put up there, that's on every news site on the internet. This may have been an isolated incident in terms of the shoe itself. It's not isolated in terms of attention. Everybody knows about this, and separate from the Colin Kaepernick thing, I mean, that was an image issue. This is a product issue, and I think if I work for Adidas or Under Armour or Reebok or anyone who's competing with Nike, I am making this part of my presentation when I'm pitching pro athletes.
I don't disagree with that at all. If I'm Kevin Plank with Under Armour, I'm figuring out any way I can jump on this thing and get more people out there, at least giving those Under Armour shoes a shot. And obviously with Steph Curry on staff there, you have some sort of sway in the market, particularly with the NBA, and we know Zion's heading there very soon. I mean, again, to your point, yeah, it's a performance issue, but think about how many people out there wearing Nike products today who aren't playing in the NBA. It's the overwhelming majority of people, right? Yeah. So, I mean, I think generally speaking, it's something that probably exits our memory banks pretty quickly. In Nike, again, I mean, they just think about how long they've been doing what they've been doing. I mean, every once in a while, you run into these sorts of wardrobe malfunctions, I guess we could call it. But I don't think it's anything that is lasting. Now, if they pull a Chipotle, okay, in another set of sneaker splits, right? Just like Chipotle had made a few people sick, then we may have an issue, okay? This is an isolated incident. If we see this repeat itself, then you have to take a look back here and start wondering what is the product problem here, because we know, hey, listen, Nike is going about its production a little bit differently now. You talk about like 3D printing and custom making these tennis shoes and sneakers and basketball shoes. There could be an issue there, but for now, it does seem like it's an isolated incident. I mean, I don't think you can invest in the stock based on that.
Yeah, I guarantee the scientists over there in Oregon and Nike headquarters are hard at work trying to figure out how a 285-pound, 6'7" power forward for Duke can split one of their shoes that costs well north of $100, and maybe even was specially created for Zion. But just understanding the amount of money and resources and time they put into developing leading technology. You know, Jason, it kind of reminded me almost when Phil Knight called out the quality of Nike clubs many years ago when Tiger switched over to those and basically caused people to think, wow, do I have the best clubs, golf clubs, to be able to compete? Ultimately, Nike ended up doing just fine.
And now that you say that, it makes me think, you remember a while back we were talking about the Winter Olympics and Under Armour had an issue with the bobsledding team, I think, the uniforms that they had for the bobsledding team?
Yep.
And so, I mean, you see how quickly these companies can get themselves out of that negative spin cycle. It's just a matter of making sure it doesn't repeat itself.
Right.
Real quick, we'll get to your questions in just 1 second. Keep them coming in the comments section. Warren Buffett's annual letter to shareholders comes out Saturday morning. Story in the Wall Street Journal today that Buffett, who has famously for years talked about his elephant gun, he loves to make acquisitions, but at the right price.
Yep.
And Buffett coming out and saying basically, there's nothing for me to buy out there.
Well, I mean, it'd be difficult to argue that the market is dirt cheap today. I think we're looking at a lot of our favorite businesses out there and thinking those multiples are a little bit high, so I do understand his perspective there, at least wanting a deal. With that said, I think there are plenty of companies out there that fit that mold of the Berkshire Hathaway, sort of letting the managers go do their thing. But, you know, with Buffett, it really does boil down to making sure you get a good price.
Yeah, he's really particular on what he wants to pay and the type of value he's going to get and the type of manager he wants to be able to work with. So you look at the balance sheet, they have well north of somewhere around $100 billion to put to work. So plenty of capital to be able to invest at the right price. But I don't think he's saying I need to stretch at this level and where the market is, and I'll be patient. And that I'm picturing the Ted Williams picture that he has on his, or used to have on his desk, that talks about the hitting zone. He's waiting for that perfect pitch. Until he finds it, he'll be pretty careful in how he invests that.
Yeah, I mean, when McCormick's price hits the right price for Buffett, he'll make that offer. We all know that's a Buffett business.
Yeah,
it's just a matter of the price.
Yeah, Jason, that's right. I mean, all jokes aside, there are a lot of very high quality, high return capital businesses, but a lot of them are selling at high prices relative to the earnings, relative to their sales. So I think he's just being very particular. So when he says he has nothing to buy, there's nothing to buy at his price range.
All right, keep the questions coming right there in the comments section. Let's get to them. Arnie asks, I would love a discussion on dividend growth investing for young adults. Should we do it or should we not do it? Thank you for the question, Arnie. Dividend stocks are generally thought of as something for people who are a little bit older, a little bit closer to my age. As you age out, you do get the benefit of that steady dividend. But it does seem like and I hate to use this word, but it seems like the stigma of a dividend has gone away. There was a long stretch of time where companies didn't want to pay a dividend because it was seen as by Wall Street analysts as, well, the growth days are over and now they're getting ready to move into a retirement facility. I don't think that's the case anymore. But for younger people, what do you say in terms of dividend stocks?
Well, I think dividends can be a wonderful way to invest and think about growing your portfolio over time. I mean, it used to be that a very large chunk, 40 to 50% of the S&P's returns over time were attributable to reinvesting those dividends. So it used to be a big driver. That has fallen because so much of the growth in the market has come in from tech stocks that tend not to pay a dividend. So, however, there are a lot of very high quality companies out there, some not all that expensive, that are paying dividends. So if you're thinking about building a portfolio over many, many years, I think balance is my advice. So I have a lot of dividend payers in my portfolio. I like to reinvest those dividends. It can be a smart way for companies to allocate capital, They have lots of ways to allocate capital. And I think for Arnie and other investors, it's a good way to get started to build a portfolio. I wouldn't, though, especially if you have years and years to invest, I wouldn't go overly concentrated in dividend stock.
Yeah, I think that makes a lot of sense. I mean, we've seen a lot of news out lately, certainly politically, regarding share repurchases. Yep. And I think a big argument we always debate is share repurchases versus dividends. Which one's better? I mean, share repurchases, that's fine. I understand you're whittling down that share account outstanding. That's a bit more theoretical in how it should affect the stock price. We know it should affect it one way, but it doesn't necessarily always affect it that way. Dividends, on the other hand, that's cash in the pocket. You can't take that away. In dividends, it's a lot like we tell people to get started investing at a young age. The more time you have, the greater an impact those dividends can have on your account. And so I think Andy's making a good point here. It's a little bit of everything, right? Don't go solely one way or the other, but having some high quality dividend names in your portfolio makes a lot of sense. And if you're looking for some of those high quality names, just Google Dividend Aristocrats and you'll find the list of all of these awesome businesses that have grown their dividends for at least 25 consecutive years. You're going to find a lot of familiar names in there, including McCormick, yep, Lowe's, Pepsi. I think McDonald's is on there. Certainly a great way to invest.
Cooper asks, do you think Nvidia will reach its previous high over the next couple of years? Nvidia, the chip maker, this is a stock that's down about 45% since last fall. I think in general this is a company we like here at the Motley Fool, but in terms of reaching its high in the next 12 to 24 months, what do you think?
Well, I don't know about that. It's come off the highs of the gaming craze, particularly tied to the cryptocurrency, where so many of its chips are going into crypto mining, and they've had some weakness in China as well, and that really has hurt that part of the business. The other businesses are doing okay, and AMD is actually not sitting still. So I don't think any of us will sit here, at least I won't, and say, wow, I think Nvidia stock over the next 12 months will be at X level. However, I think long term, the space that they're playing, the leadership team they have, the founder-led organization they're running, the type of research that they're doing, gives them a very good chance that stock will be materially higher once that crypto craze rolls through, which I expect that to be next quarter.
Yeah, I think there was a pretty healthy level of mania going on when Nvidia hit its highs, because we're talking about gaming and crypto. I think that Nvidia has proven itself to be a major player in that chip space. I think the challenge that these chip companies face, even when they get to that scale, is they're spinning that hamster wheel of innovation constantly. Once they come up with something great, they have to come out with something else that's even better. Yep. And that's very difficult to do. Not to say that Nvidia can't do it, but you do have to remember, there's an argument out there to be had that maybe we're a little bit closer to recession than further away when something like that happens. I don't think any company's immune. So seeing Nvidia get back to those all-time highs like it did is probably a bit of a tall order.
Later in this video, we're going to get to 4 stocks to watch next week because they are reporting earnings next week. Before we do that, though, Donna asks, if you could only buy one stock to hold for 10 to 20 years, what would that one stock be?
Wow.
10 to 20 is a great question. That's an awesome question.
I'll just say for me, if we're looking 20 years out, I would go with what is my largest holding, which is Starbucks, simply because I don't know what technology is going to look like 20 years from now. I know what coffee is going to look like 20 years from now, and how I'm going to get it in my body.
That's a great point. I guess I'll point to MasterCard, which I just think the moat that they are building, symbol MA. And Jason, I know you follow it closely also with your Warren Cash bucket. Just thinking about commerce and the way that we are conducting and paying for things, MasterCard has a little piece in so many spots. While there might be some regulatory concerns over the years, I still think they're at a size that they continue to grow, they generate exceptional returns on their investments, and as we get more and more tied to digital currency, I think the likes of MasterCard over the next decade will continue to do quite well.
Yeah, I like those choices. As a matter of fact, I think I responded to a question that we tweeted out on our Motley Fool Twitter feed in regard to this, and my answer was PayPal. And I think for a lot of the reasons that you just mentioned, I think that money, generally speaking, is going to be very difficult to disrupt over the course of the next 20 years. How we spend it is a little bit of a different story, and I think PayPal is sort of helping in that regard. We're moving towards this cashless economy, cashless society, and whether it's PayPal or Venmo or whatever other names they bring into that portfolio, Zoom, of course, that remittance company sending money overseas. I think there are a lot of different ways for PayPal to win, and given the company's valuation today, I think it's still reasonable to see this as a 10-bagger over the course of the next 20 years. And I'll give you one honorable mention, something that's probably under the radar for everybody. It's that little small Georgia bank, Ameris Bank Corp.
Yeah.
Okay, they just acquired Fidelity. It's going to give them exposure to Atlanta, Jacksonville, Orlando. It's a small bank. It's less than $2 billion market capitalization. I think that's why I like it. Banking companies, banks, they're a lot like insurance companies in that they are figuring out ways to invest that deposit base. And as Ameris continues to grow that deposit base, they've proven themselves very adept at investing that deposit base, and given its size today and essentially how banking is going to look even 20 years from now, I think it's going to be kind of the same as we're seeing today. I think Ameris is another good option.
You know, I will say we all named very large cap companies, and certainly over the next 20 years, the best performer from today will probably not be a large cap company. It'll probably be a smaller cap company. History will show that. There's only so much growth you can get from large cap companies. So a small company, one I'm watching today is The Trade Desk, which is a $6 billion company, and they specialize in programmatic advertising trading, both online and offline trading, and posting ads into our web pages. So they report today a company that's small and growing very fast and can continue to innovate and tap more and more growth channels will probably be the one that ends up being the best performer over 20 years. But Chris, to your point, it's not nearly as consistent, and the stocks will be quite volatile over that time period.
And I will say, I recently interviewed Ameris CEO Dennis Zember on Industry Focus, so maybe a little bit of recency bias here. And I'll be very clear, I own shares of Ameris myself. Yeah. I was just really impressed with that interview. I mean, he seems to be very much the mindset that we are building a business for the long haul, proud of the culture there at Ameris. I expect big things from them for many years to come.
Jill asks, looking at Facebook, do you think it's time to sell? Great question, Jill. And certainly Facebook has been in the spotlight, probably in ways that they didn't want to be over the last 12 months. This is a stock trading around $160 a share. That's down from its highs. I don't know. They are still, for any qualms people have about privacy issues, as warranted as those may be, this is such a dominant player when it comes to the advertising business.
Yeah, I mean, I think human behavior is fairly predictable, and it's really difficult to change. And I think a lot of people today are used to that social aspect of their lives, living it out online, whether it's via their phone or laptop. I'm not the biggest Facebook fan in the world, but I also understand the size of that network and the number of networks that they possess with that company. Extremely difficult to disrupt. And so given its market, given what they do to make money in selling advertisements, I think they're always going to be a place where most of the eyeballs are. Yep. So I have a hard time believing if you invest in Facebook today that you're not going to make money.
I wouldn't sell it. I own it personally. Revenues were up 30% last quarter. Their mobile ad revenues were up 36% and now represent more than 9 out of every $10 of ad revenue they generate. More than 7 million advertisers across the platform. So when you just think, as Jason's pointed out, and so rightly, is that the network they have in that garden, not just Facebook, also Instagram, and the optionality they have in that platform. Yes, they have some concern. We have some concerns with what's going on with privacy, and certainly some management stumbles over the last 18 months. Hopefully they're learning from that. It's exceptionally profitable, very good returns on their investment. So I expect better days from Facebook, so I wouldn't sell it here.
Several viewers asking about the marijuana industry. Sort of, what kind of company should I keep my eye on? Are there any specific stocks to watch? This is an industry that has gotten so much attention over the last 12 to 18 months. Maybe some of it is unwarranted. You tell me, Jason, this seems like, in all of our conversations, this seems like an industry where there are going to be some winners. I don't know about you. At this point, I don't know who they're going to be.
Yeah, I think that's really difficult to figure out at this point, right? I think what we have is this problem of a lot of excitement about this opportunity and therefore a lot of money flowing into it. And that money is not very discriminatory at this point. It's going into all of the good ideas and a lot of the bad ones too. And so just because there's investment dollars going into those bad ideas doesn't make them good ideas. So I think investors really interested in this space ought to exercise patience, sit back and wait to see how this all shakes out, particularly as the legislative environment here domestically shakes out. Because we know in Canada, it's a bit more of an understandable situation here. Domestically, we're still waiting for the legislative picture to make a little bit more sense. So when I think about investing in this sector today, I think you look at companies like Constellation Brands, for example, that's the beer maker with Corona and other brands. They're placing some bets in that sector. We see other beverage makers makers considering that as well. I think look at those companies that are already well capitalized, that can make investments in this space without really putting too much at risk. That's a nice way to kind of dip your toe in the water. And yes, certainly keep an eye out for the businesses that are pure plays, but please exercise patience, because I do think that we're seeing just the problem of a lot of money flowing in there, which is pushing valuations on all of them sky high at this point.
Mark asks, I've owned the Walt Disney Company for 15 years. Do you advise selling some or buying more? I'll just say as a shareholder, I'm not doing either of those.
I was going to say door number one, door number two.
Yeah.
Is there a door number three there that we could tap? I certainly wouldn't sell it. I would definitely hold. I mean, what just the brands they have, the dominance they have now in the media space across the globe. Just when you think about all of the options that they have to pull and the levers and the value and the profits and the media brands, from the movies, television, their new streaming business that's coming online. I just think Disney over the next 5 years will be much more important to the media lives of each of us than it is now.
Yeah, I mean, I really agree. I mean, I don't think it's something that you sell. I mean, I guess everybody's situation is unique. I mean, if you're super overweight Disney, maybe it is worth trimming the position to put money elsewhere. But I think this is a company that is still going to be just as relevant 10 years from now as it is today, probably 20 and 30 years from now, because every time we see a new generation of media-savvy consumers coming into the fray there, Disney is always a part of it.
Yep. Lost my place here. RG asks, how would you build a growth and dividend growth portfolio for a 25-year-old son for 30 years, excuse me. So building a portfolio for someone in their 20s looking to have those stocks last for 30 years. Right off the bat, I would say get your son involved. And we've talked many at that time about getting kids investing. The sooner you can get them investing, the better. And certainly one way to do that is find out what their interests are. Because the easier it is for them to follow the stocks themselves, the more interested they're going to be, the more they're going to take control of their financial life.
I love, Jason, you and I, we both have daughters, and we've been talking, you've talked to me about investing and with them over the years, and I've just now started to do that. They're younger than your daughters, but the other day my daughter asked, hey Dad, remind me, how much of Netflix do we own? And I was like, well, honey, it's just a tiny bit. But it allowed me to just have that conversation about products and companies and leadership teams and market opportunities. And I think the best way to the RG's question about building a portfolio is, especially if for someone at that age, Chris, get them involved. Definitely start on the growth side, the smallish growth side of businesses and products they may know and love. To start there, focus mostly on the growther side, sprinkle in some dividend players for some diversification over the years. But Chris, you're right. Get them involved in it. Teach them about investing principles and the benefits of tax advantage, long-term buy and hold investing.
I love it when I tell my kids, you remember you own one share of Amazon. They're like, oh yeah, one. I mean, you know how much that share is worth. They're like, no. And I'm like, about $1,700, and their eyes just light up. Oh, really? Yeah, I think what Andy's saying makes a lot of sense. At that age particularly, really, I think you have the opportunity to take a little bit more risk. Maybe a couple of dividend players here or there, I mean, that's fine. But really, yeah, you have a lot of great opportunities to invest in some terrific growth stories there at that age. As you get a little bit older, you sprinkle in a few dividend payers along the way, but it's a nice way to mix it up.
Tyler asks, over the long term, do you think company share buybacks are a good thing or a bad thing? I look at share buybacks, they're a tool, right? They're a capital allocation tool. It's kind of like a hammer's a tool. What are you going to use the hammer for? To build a house or to hit someone in the face with it? So it's, share buybacks, if they're doing them right, I'm a fan.
Unfortunately, most companies don't do them right, and it feels like you got punched in the face. And I think that's the problem I have with them. If you look back over time, I mean, there's clear data out there in the S&P that most of these companies, they get share buybacks precisely wrong. They're buying at highs, and when things start going down quickly, they tighten the purse strings and don't buy anything. So every once in a while, you see companies that execute it very well. And that's great. I like to see that. But on the whole, if I see a headline where a company says we're authorizing another $5 billion in share repurchases, that's not something that gets me excited, Chris. It makes me want to take a closer look as to what exactly are they doing, and do they have a history of buying back at the right time?
Yeah, I think they're those who do it really well. I mean, Berkshire Hathaway and Warren Buffett and his team have talked about when they invest and very principled about when we're going to go buy back stock. A lot of companies use buybacks to offset share dilution that they issue to their employees. I'm mixed on whether that's good or bad, but I think Jason's point is right. CEOs and CFOs are individual investors, and just like individual investors often get the buying times wrong and buy at the highs and sell at the lows, they do the same mistakes that so many individual investors do. So I think, Chris, you're right. It's a tool. It's to be used in smart ways. And if you get teams and CEOs that do that well, and Will Thorndike wrote a whole book on this called The Outsiders, about 8 phenomenal CEOs who over the years have bought back a lot of stock to make each person's individual ownership high worth that much more. It can be very effective, but that's more of the exception than the rule.
Yeah.
Neha asks, I'm a big fan of Jason Moser.
They now.
Recently, I purchased Teladoc. It's up 60% since I bought it. Do you suggest I take my profit?
I suggest you do not take your profit. Join me in holding your shares for the long haul. Listen, I mean, I think Teladoc is a company with a lot of opportunity ahead. Still a small company, around a $4.5 billion market cap.
And for those unfamiliar with the business?
Yeah, I mean, we're talking about virtual healthcare. I mean, at its very core, Teladoc is an app on your phone where you can see a doctor via virtual visit, whether it's a phone or a video conference. I mean, I've had experience with it a couple of times, so as a user, I can see that it worked very well. I think in a lot of cases, it's just a more logical first step into initiating that doctor's visit. And most of the time, it comes at a very affordable copay on the patient's part. So either your insurance company has added it as a value add to the plan, or perhaps you have that option just as a not a member, but you have access with that little copay that you make. But it's worth remembering too that they're beyond just virtual healthcare. They're getting plenty of share in the second opinion or the expert opinion market. It's a global company with a global presence, and at its size today, I think there are more reasons to hang on to the stock than to sell the stock. And I know I'm keeping my shares, and so I recommend that investors out there who own them hang on to your shares too.
Well, and Andy, obviously, it's always exciting when you own a stock, you see it up, certainly if you see it up that much in a relatively short amount of time. So I understand the temptation, but in general at the Motley Fool, we're big fans of buy and hold.
Well, not just that, Chris, we're fans of it, but also studies show that individual investors trade much too frequently, and they take profits when they shouldn't. And really, you need to be able to, it's not necessarily the buying that really lasts to long-term wealth creation. It's the holding, just to be able to hold, invest in these great businesses like Teladoc and so many others we mentioned, and to be able to hold those through the ups and downs of the market, add more at prices as you can, and build out your portfolio that way. That's really the best way to win in the long-term investing game.
And I will add one thing here. That we talk about this a lot, the holding part. In the way we talk about it, you would think maybe it's pretty easy to do. It's really not. Yeah. The temptation is great. When you see a company, you've owned the stock and it doubles and you're thinking, wow, I could sell that thing now and it's cash in the pocket, I'm good to go. The holding part is really difficult to do. But the more you do it, the easier it gets. And I also think really holding becomes a lot easier the better diversified you are. The more of a diversified portfolio you hold and you're not focused on one individual stock in that portfolio, it makes holding a lot easier, because I am relatively certain that Teladoc's share price will be lower at some point than it is today. That's all right. As long as the fundamentals of the business are still sound, I think there's reason to hold it. But yeah, keeping a diversified portfolio will help in that holding process, because it's not the easiest thing to do.
All right, let's get to some stocks to watch for next week. They're going to be reporting earnings. Andy, let's start with Home Depot. They report on Tuesday. This is a great company. Last 12 months, this hasn't been a great stock.
Yeah, it hasn't. Over the last 5 years, though, it's up 19% a year. Last 10 years, up more than 24% a year. The largest home improvement retailer. They have 2,200 stores across North America, more than 400,000 employees. Just the machine that Home Depot was building with their sales performance, their same-store sales performance. Comps last quarter were up 4.8%. Sales were up 5%. That comp, by the way, Chris, included a 1.2% increase on transactions and a 3.5% increase on average ticket price. So Home Depot continuing to get it right. They actually guided for a little bit higher performance in Q4. So really just thinking about what they are doing to continue to innovate and invest in their online, what they are calling their One Home Depot, their online plus offline mixture. I certainly spend a lot of money at Home Depot just working on as a homeowner. That's just kind of what you do. And so looking to see how they continue to innovate in this one Home Depot. They're going to spend billions over the next 5 years getting all their supply chain right so they can meet the demands of the online and the offline buyer.
Great tool rental place there. I mean, Chris,
Absolutely.
I was putting a tile backsplash around a shower a few months back. I had to rent a tile cutter. Go to Home Depot, rent that puppy, and turn it back in a day later. I mean, it only cost me $50, and now I don't have a tile cutter that's sitting in the garage gathering dust.
Yep.
Etsy's going to report on Monday. This is a stock that's had a phenomenal 12 months, up about 150% over the past year.
A phenomenal past really probably two years or so. I mean, CEO Josh Silverman came in, I think, May 2017, and what the stock has done since then has been nothing short of phenomenal. I mean, I really do like this business. I mean, I own shares of it myself, but the beauty of it is it's a network. It's a capital-light business. They don't carry inventory. They're creating an online marketplace for people who enjoy craft goods or, homemade things and stuff like that. And they do really make it very easy to develop that storefront, and they sell you all of those little value adds to go with it. So you can run your own kind of little business really with Etsy, and they've developed a tremendous brand name in doing that. And so really with Etsy, as it's an e-commerce platform, we're paying attention to the 3 key metrics in the gross merchandise volume that goes through that platform on a quarterly basis, the total active sellers and the total active buyers. And if you look at those numbers all the way back a few years, I mean, it's one consistent line straight up. So I expect to see big things from these guys for many years to come. I like what they're doing. Still a fairly small company, but kind of running counter to a lot of those tech businesses out today in that it's very profitable and very cash flow positive, and I like that too.
Booking Holdings is reporting on Wednesday. Andy, this is the parent company of Priceline. Strong company, diversified company, stock basically flat over the past year, but this is one of those things that if you bought a few years back, you're doing quite well.
Oh yeah, you're doing really well, Chris. I mean, the growth levels have kind of stagnated a little bit over the last couple quarters. They're expecting a little bit of more growth for this quarter. They're really the marketing machine that they have built to be able to spend maybe 30 to 40% of all their revenue on sales and marketing to be able to generate high returns on investment. That's really just what they have built so well with Booking.com. So they have Priceline, Kayak, Open Table now as well too. So looking for sales growth of about 13 to 16%. There are some currency swings in there because it's such an international company, but they have a very large share of all of the hotel and other bookings and other properties that are listed around the world. So when I think about the long-term opportunity for Booking Holdings, it's still a $90 billion company. I think the opportunity is really large, and I own shares myself, and I would continue to hold them here.
Next Wednesday, Jason, Square's reporting. We were talking earlier about payments companies, the war on cash. Square plays right into that.
Yep.
Stock up close to 70% over the past year.
Yeah, this has been a tremendous offering since they went public. Jack Dorsey, as we know, the CEO here, splitting time with Square and Twitter. But his mandate as a CEO of 2 companies has always been really to make sure he's just getting the right talent in the right places. And I think if you look at both of these companies and what they've done since he's been at the helm, he's executing. And so with Square, we were talking about companies earlier that we want to hold for the next 20 years, and I brought up PayPal. Square is probably one of those businesses that I'd throw in there in the running as well. Just a little bit of a smaller company, a little bit of a riskier play at this point because they're still growing the business, not nearly as profitable or cash flow positive. But, I mean, they've built a strong ecosystem of hardware and tremendous software to go with that hardware. Easy to use, very data rich, and they're finding that their merchant partners love it. So for me, I mean, the company was founded on the purpose of economic empowerment. They're trying to give everybody the opportunity to build their business and grow. And when we talk about networks, we talk about PayPal, somewhere in the neighborhood of total payment volume that flows through all of their networks, closing in on $600 billion. Square is just a tenth of that. Mm-hmm. And so it shows you the opportunity that's still ahead for Square if they continue to execute. A lot of exciting opportunities there in Square Capital, Square Financial Services, maybe disrupting the SBA a little bit out there, making it easier for these small businesses to grow. Just a lot of things they're doing that I like, so I think you got to be excited about it.
All right, Jason Moser, Andy Cross, guys, thanks for being here.
Thanks, Chris.
Thank you so much for watching. Please click the subscribe button in the lower right-hand corner. We're going to be doing more of these, taking more of your questions. I'm Chris Hill. Thanks for watching. We'll see you next time.